Thank you everybody for coming today. My name is Sean Thompson, Director, Investor Relations for Atlantic Gold. On this opening slide, I'd like to direct your attention to the headline, lowest cost gold producer in the sector. This is something that was pointed out to us by some investment bankers and analysts last year from some research that they'd done, something we're very proud of as a company. We've worked very hard to achieve, and we remain very focused on maintaining going forward. Please note we will be making forward-looking statements throughout this presentation. I'd like to begin with what we call our key differentiators. This is really what sets us apart from our peers in the gold sector. First point being shareholder alignment. Board and management own in excess of 35% of the company. Yes, we are aligned with shareholders. Yes, we have skin in the game. Track record. This will be the third gold company Chairman and CEO Stephen Dean was part of building. He's held senior roles at Teck and Normandy Mining, which was Australia's largest gold miner before being acquired by Newmont in 2002. Our president and COO, Maryse Bélanger, also comes from the big end of town. She's held senior VP positions at Kinross and Goldcorp. She's been very instrumental in helping us attract some of the best technical people in the world to come work for Atlantic as well. Analysts and investors that have been to site will tell you that this mine shows like a senior company asset. Risk management, we executed a fixed price contract on construction, which resulted in a plant being built on time and on budget. It not only continues to perform well, but is actually exceeding design criteria. We implement grade control drilling to help us better delineate ore from waste. Time is money. As large shareholders, we execute fast. The gold industry typically writes off things such as holding costs, overhead salaries. This ultimately is not good for you as a shareholder in the end. We move fast. We've gone from concept to commercial production in just over 4 years' time. We are in the lowest decile for both cash and all-in sustaining costs. We've got an expansion plan to boost production up over 200,000 ounces per year by 2022, essentially doubling our production. And we've got considerable upside with what we call our string of pearls deposit strategy along the plus 45 kilometer untested host structure. We're calling this our corridor regional program. We are located in Nova Scotia, Canada, about 45 minutes from the Halifax International Airport. You can have a pizza delivered to site. Our staff is able to drive in and out. They get to go home, have dinner with their families after work. There's no camp. Parts and supplies can be delivered with a phone call within 2 hours, so we've got considerable location and cost advantages here. This is what we call our four-phase approach. Phase one, we declared commercial production March of 2018. We delivered on our full year 2018 production guidance, actually coming in beyond the higher end of that range, just over 90,000 ounces. We just announced that earlier this week. The cost guidance is also in line as of the third quarter 2018 financial results. All-in sustaining costs were 726 Canadian per ounce. That equates to US $544 per ounce at today's exchange rates for those preceding 3 quarters. We just released our 2019 production guidance, and that is between 92 to 98,000 ounces at, again, low all-in sustaining costs of Canadian 695 to 755 per ounce, US 521 to 566 at today's exchange rates. The fourth quarter financial results and full year 2018 financial results will be released March 5th. The Phase 2 expansion comes from integrating an additional 2 satellite deposits into the life of mine plan. That's the 15-mile stream and Cochrane Hill deposit. That will increase gold production eventually up over 200,000 ounces per year. Phase 3 was really growing and expanding those resources at 15-mile stream and Cochrane Hill, and we'll have an updated resource reserve and life of mine plan estimate out this quarter. Phase 4, our exploration, what we're calling our corridor regional program, we're going to be drilling up to 100,000 meters along the plus 45 kilometer untested host structure, which currently hosts all 4 of our deposits. 2018 production highlights. The grade was in line with the life of mine reserve grade. We're finding good resource model to production reconciliation. Gold recovery of 95% for 2018, and we finished the year beyond the upper end of our full year's production guidance. We're strengthening the balance sheet. We're growing our cash, we're reducing our debt, we've got strong operating cash flow. We are profitable, we are making good monthly cash A quick look at our share structure. I'd also like to highlight that in September of 2018, we closed the refinancing of our debt facility with a $150 million revolving credit facility. We've got a clean balance sheet now with net debt of about $60 million and total cash of $45 million. In this volatile gold price environment, we are able to mitigate the gold price risk. The Canadian dollar gold price, as you can see, has been less volatile versus the US dollar gold price. In fact, it's only about $200 off of its high back in 2011. We also have a hedge facility on a small portion of our future production at Canadian 1550. As I mentioned, we are the sector's lowest cost gold producer. This is Atlantic Gold on the far right versus our junior and intermediate producer peers. The seniors would also be on this graphic, but it was just getting way too busy, and we all know that they would be to the far left of that graphic anyway. The question really is, how are we the sector's lowest cost producer? It's not any one thing. It's a combination of several things, being location, grade, excellent recovery, low strip ratio, the Canadian dollar exchange rate being favorable for us, and of course, as our President and COO, Maurice, likes to mention, it's our team that's delivered that. The Phase 2 expansion comes from the 15-mile stream and Cochrane Hill deposits, as you'll see on this graphic. All deposits are within trucking distance to the central processing facility down here at Touquoy. 15-mile stream and Cochrane Hill will be pre-concentration facilities, and we will be trucking a concentrate to the central processing facility at Touquoy. This is the life of mine plan as of January 2018, so almost a year old now. This is based on resources drilled to July 2017 at 15-mile stream and Cochrane Hill. We've since drilled 100,000 meters in order to backfill those arrows you see to the right of the graph. And we're going to be releasing the updated resource reserve estimate and life of mine plan this quarter. Phase 3 expansion was targeting extensions to 15-mile stream and Cochrane Hill. And I'd also like to highlight that in October, November of last year, we drilled to the south of the current pit at Touquoy, where we're currently mining, and we hit mineralization in line with expectations. We're finding that it was showing good continuity of grade and disseminated mineralization within the argillites, and that, again, is at Touquoy. This is 15-mile stream. The orange outline is the resource as of July 2017, resulting in the Phase 2 life of mine expansion plan in the top right corner. We've done further expansion drilling at Hudson and Plenty, and we've done more drilling at Egerton McLean as well throughout 2018. Similar thing with Cochrane Hill, the orange outline being the resource as of July 2017. Here we've discovered a robust zone of mineralization below the previous pit design showing high-grade intercepts. The deposit's open to the east, and we feel there's really good potential here to add high-value ounces and expand the current in-pit resource. This is what really gets us excited. We're going to be drilling up to 100,000 meters along the corridor. In fact, the first discovery was what we call the 149 deposit, right up here, and that's located about a kilometer from 15-mile stream. We hit shallow mineralization here over a 350-meter strike. That's now been extended to over 475 meters of strike and open to the east. Theoretically, you could fit 50 Touquoys along this corridor. We feel we've got a good chance of identifying at least 4 over the next few years. Long-term strategy, we're either going to grow and become like our senior producer peers using Oceana Gold and B2 Gold, and as an example here, we will use Moose River as our cash engine to do that, or we will be acquired at a premium, whatever receives the highest return for our shareholders. Upcoming catalysts to look forward to, we'll have the full year 2018 financial results released on March 5th, the updated resource reserve estimate incorporating Phase 3 resource expansion drill results, plus additional drilling at Cochrane Hill, 15-mile stream, 149 and Touquoy this quarter. Drill results from the corridor regional program will be ongoing throughout 2019. That's it for me. Thank you very much.